Hi, my name is Karin Ko, and I'm the head of Southeast Asia here at Hamilton Lane. Joining me today is Juan Delgado, our co-CEO and a member of Board of Directors. As we all know, the key to financial well-being is not just about achieving returns, but also doing so without losing too much sleep. Today, we'll be discussing the important topic of diversification. Specifically, why diversification is a crucial strategy for protecting and growing private wealth portfolios, and how diversification strategies are used by institutions and large families, and how they can be applied to wealth portfolios. The first principle of diversification is simple. Don't put all your eggs into one basket. And diversification's power lies in how it can address multiple risks and also propel growth. Welcome to today's discussion, Juan.
Thank you. Happy to be here.
The first topic which I would like to pick your brains on is on asset class diversification. Most investors have allocated traditionally to public stocks and bonds. And in recent times, the growth of evergreen or semi-liquid strategies have provided investors with greater access to private markets. Do private markets provide additional diversification benefits to investors? And if so, which private asset classes should they look at?
Strong yes. Private markets give investors meaningful additional diversification that complement traditional public market exposure. The diversification benefits stem from broader sector, geographic, and asset class opportunities, lower correlations to public markets, and unique risk-return characteristics. As to the second part of your question, asset classes, it depends on the investor's goals and their risk-return profile. But for example, infrastructure offers inflation protection and steady, predictable cash flows due to long-term contracts, whereas venture capital and growth equity offers exposure to high-growth companies and significant return potential but higher risk. So there is a range.
Right. And moving on to the second dimension on geography. And since we're both based in Asia, we do have a front row seat to both developed as well as emerging markets. And developed markets have traditionally offered more stability, consistency, and resilience to economic shocks such as compared to emerging markets. And in comparison, investing in emerging markets such as China, India, and Brazil may be higher risk, but also present higher growth opportunities. And in fact, emerging markets are often less correlated with developed markets, which can help to balance a diversified portfolio. And in your conversations with large institutional investors, how do they think about geographical diversification, and how should wealth professionals think about geographic diversification in their own portfolio allocations?
Again, this is a very important topic and a topic where institutional investors spend a lot of time, and I think private wealth investors should do too. I speak a lot with investors all over the world, and what you hear is sources of consistent returns, diverse portfolios can really help manage market volatility, potentially supporting a steadier long-term return base. You do want that access to growth opportunities that you mentioned that you often find in emerging markets with significant growth potential, and even developed regions that might be away from sort of the core US and European exposure of many portfolios. Carefully evaluating these opportunities to balance this high risk and return potential may indeed enhance overall portfolio performance. And then as to the risk reduction side of diversification, you always have political risk, and you always seek a political stability and economic stability. So actually having a wide geographic diversification does allow you to have this reduction of political upheaval, economic downturns, natural disasters in a specific region. So all of this is critical given the fact that we live in an unpredictable world and you have unpredictable global economic cycles.
Right. And picking up on what you're talking about, cyclicality, we also have cyclicality in sectors as well. So, like geographical diversification, do you think that spreading investments across various sectors can also cushion portfolios against downturns in specific sectors? And in some of the markets in which we're active in, we also have seen deal sizes increase exponentially. How should investors think about sector as well as size diversification?
Here's one where listeners might be surprised. We advise avoiding over concentration in trending sectors. Sometimes those are the ones that attract, really, by their very nature, the interest and the attention. And private markets are a great tool, a great diversifier in your portfolios away from that hype. And I'm not referring to today's hype necessarily, but we've seen that through the dot-com investing in the 90s, etc. In today's market, it's not uncommon to see investors over allocated to tech on the public side, given the Max 7 of the S&P 500, already making up more than 30% of the index. So in the public markets, they might have already seen that concentration and that trendiness of the tech component. In private markets, you do not have to have the same magnitude of concentration risk. You should look for investment solutions that are thoughtful in spreading that sector risk, crossing a range of sectors, and look for that in your own portfolios. The size point you made is interesting too, because there's also a drift to large cap and mega cap on the public markets. And deal sizes in private markets have also been increasing as investors look to invest more in large companies. However, the middle market companies may have very reasonable valuations, more exit pathways, and have been really forever the bread and butter of private markets investing.
Something that's very close to my heart, currency diversification. Sitting outside of the US today, I'm hearing a lot about currency hedging and potential further dollar weakening. This was not something that we talk about as much in private markets. How do institutions think about currency hedging? And is this something that wealth professionals should look to adopt?
Well, it's never been more important and relevant than now. And I should say, by the way, you're from Asia, and I'm actually recording this in the US. Investing in assets denominated in different currencies can hedge against the risk of any single currency's devaluation. And that's why this is super important at the moment. This helps protect the value of the investments against fluctuations in exchange rate. And the dollar volatility is front of mind for institutional investors, and should be as well for private wealth investors. After all, the dollar has ended the first half of 2025, 11% down, biggest loss since 1973. Could it drop further? Certainly on the cards. There's prediction of a further drop. And therefore, non-US based investors who are big owners of dollar assets are concerned. They are thinking of ways to diversify and to manage this risk. So what can private markets do? Effectively, there's a number of strategies that you can use to try to mitigate that play to the strengths of what you would call natural hedges. To hedge or not to hedge is a portfolio level question that investors will have, and they have FX tools, but managers can also build a natural hedge into portfolios using private market investments that are intrinsically and negatively correlated to offset that risk. So instead of relying on derivatives, natural hedges are created through asset allocation to provide resilience against specific market forces like inflation or public market volatility. For example, infrastructure is naturally hedged due to long-term contracts and the essential nature of predictable cash flows. And oftentimes they have provisions that automatically adjust revenue for inflation. Real estate, another good example, strong hedge against inflation because property values and rental income can rise with or faster than inflation. So those are some of the examples that private investors should consider as well.
Maybe switching tracks a little bit and going down to a different layer about GP diversification or manager diversification. While investing in private markets, many investors have started to encounter funds which are single GPs or multi GPs. Can you explain a little bit on what this means? And is GP diversification an important factor in your perspective?
We think it is, and it's simple to explain. In a single GP fund, the same manager sources and invests in all the deals in the portfolio. So you get one flavor. Think of ice cream, that's vanilla. That's the same manager all the time in every deal. That means that manager has all the capabilities across a wide range of geography, sectors. It's all one flavor. In multi-GP funds, not necessarily fund of funds, but funds that get exposure to a cross-section of co-investments and secondaries, that can be diversified away because you are effectively investing across multiple GPs. And that's a really important dimension of diversification that sometimes gets overlooked. These funds tap on specialist expertise across geographies. You can have a different GP for different geography, for different sectors, without having that single manager concentration.
Yeah. Aside from that, are there other main portfolio considerations when thinking about diversification strategy for you?
I think this is a nice summary. I think people think of private markets oftentimes as concentrated, illiquid, intrinsically riskier than public markets. And what we covered today, I think, emphasizes how different strategies across private markets, how the use of geography, sector diversification, company size are really important dimensions to arrive at a diversified and a good risk-return balance in the portfolio. I do have a question for you, actually, if you don't mind, Corinne.
Right.
So you very large investors like institutions have leveraged this diversification before as both a shield and a growth engine, as we are describing. In your experience, what are some of the best practices that wealth investors can adopt from those very seasoned institutional investors?
Thank you. In speaking with a lot of institutional investors in my day-to-day conversations, I think there are three areas which advisors can look to incorporate. First is incorporating private markets into portfolio allocations. Many sophisticated pension funds, endowment funds, sovereign wealth funds have achieved strong returns and also over long periods of time. And this is through allocating 10 to 30% of their portfolios to the private markets. We believe that a key to success is actually consistent exposure over time. Timing private markets can be very challenging, but over the longer term, by staying consistently invested, private markets have historically outperformed public markets. So I do believe that advisors can enhance diversification through allocating to private markets across different geographies, as you said, different sub-asset classes. This helps to reduce risks and enhance returns beyond the public markets. Second is in investing internationally. Most wealth investors tend to have a home bias in investing, while institutional investors tend to invest more internationally, and this really allows them to capitalize on more diverse economic growth engines and drivers. And last but not least, consider different dimensions of diversification. I think you rightly mentioned that this including strategies that are across multiple GPs or even strategies that are multi-GPs in themselves, because these enable institutional investors as well as wealth investors to capitalize on different specialist knowledge and also helps to reduce manager concentration as well. So one, in recent times, it has been trending that many investors have come to private markets looking for very specific exposures, sometimes a single company. What is your take on that, and how would diversification play into these kind of investment styles?
Absolutely. I think actually it's more often the case than not that investors hear about companies that they know. The issue is companies that are particularly successful, large, still privately owned. And so the pitch is, how else can you get exposure to insert a name, right? SpaceX, OpenAI, amazing companies. That's why you should come to private markets. Get that particular company. Who has access? And I think that relates entirely to your comment of chasing trends and avoiding concentration. You should diversify. Would you put all your money in public markets in one company? You would never do that, regardless of which company that would be. So how can private assets be different? And so the topic of the day is precisely that we welcome your attention to private markets, but let us show you how it is absolutely essential that you think of multiple private companies, not a company you know, not a particularly very large company in many of these cases. We talked about size, we talked about geography, but it's kind of like there's a tension there. The company that I know in private markets, and it can be something very local. You and I remember being in conferences in Singapore when Gojek was the company everybody wanted to talk about. That's great, but private markets is so much bigger than that. And sometimes we need to bridge that gap from the initial attention to the portfolio construction and the diversification that we are discussing today.
Right. So don't put all your eggs in one basket, even if
Right.
it looks like a very exciting basket.
Right. Even if you feel you know the egg and you know the basket.
And with that, we've come to the end of today's webinar. Thank you so much, Juan, for your time, and thank you everyone for listening in.
Thank you.